Welcome back. Let's get to our Midcap Spotlight segment. Mangalam is joining in and he's going to be focusing on Varun Beverages. Mangalam?
Good numbers coming in from the Pepsi bottler. 32% growth in the company's revenues year on year, 41% jump in their EBITDA on account of revenue growth, as well as the net profit grew by around 53%. Quarter on quarter, there is a dip, but that's understandable because remember, the previous quarter was the summer quarter. So as a result of which we do see higher sales coming in from there. The good part is that India business had an organic volume growth of 22%. The realizations grew on account of a higher mix of smaller SKUs. And the reason why smaller SKUs did well is because those are the SKUs or stock keeping units which people buy when they are on the go, as against when they are at home, they buy bigger bottles. Strong performance of their energy drink Sting also helped their realizations, and as a result of which margins did extremely well. And the international business also had a 31% volume growth. The company says that in the fourth quarter of this calendar year, they follow the calendar year, it is expected to do better because of the festive season as well. But for me, the biggest positive that the company's done this time around is that they've entered into an agreement with PepsiCo to distribute Lay's, Doritos as well as Cheetos in Morocco starting from January. And this is a move away from just beverages and a deeper relationship with PepsiCo. And in India as well, they've started trial production of Kurkure Puffs at their production facility in UP. What this basically does is diversifies their revenue stream, deepens this, the relation that they have with Pepsi, and actually makes all the quarters get equal amount of revenue as against just revenues concentrated in the summer months. So currently 70% of their revenues come in from carbonated soft drinks, 5% from juices and 25% from water. The juices business started just a few years ago. Let's see what the snacks business does for them going forward.
Okay, all I could hear right now is snacks, juices, drinks. So
carbonated drinks, and I think the demand is good, right? Across all segments, as a consumer.
Yes, that's true. Mangalam, thank you so much for that. Whenever you talk about any of your earnings, it's all about products that we all can consume. So that's about the consumption sector. But let's move on and talk about Bharat Electronics. It is surging in trade today on the back of some new brokerage calls. Vaishta is here with the details. Vaishta.
Hi Sonal, thanks for that. You're right, actually BEL is surging in trade today, and this is because the Q2 FY23 numbers were out in the past week and the numbers have been more or less in line with the estimates. In fact, the stock has rallied 55% on a year-to-date basis. The management has said that they are confident to meet its 15% revenue growth guidance, and the lower band of the margin guidance has been revised upwards from 21-23% all the way to 22-23%. So some good news. In the long run, also they expect the margins to grow further, and it may come to 24%. The order inflow shall comfortably be beyond 20,000 crores. Also, Bharat Electronics has recently set up a new plant of lithium-ion cell and battery packs in Pune with a small investment of approximately 40-50 crores. Also, the announcement of the fourth positive indigenization list, which includes some 40 items, will provide further revenue growth potential for BEL in future. The company has said that there are no delays in receiving payments from government, which has led to an increased cash balance for the company as on 30th of September 2022. Now, in terms of brokerages, the street is quite confident on the long-term growth story of BEL, given its strong order backlog, the order pipeline, the recent MOU in hydrogen fuel cell. There is a diversification into newer business verticals like hydrogen fuel cell EV batteries. There's a greater focus on export markets also. They expect $60 million of exports in this year. There is also a ramping up of non-defense businesses in e-mobility, in railways, in metro and smart cities. Phillip Capital has a buy rating on the stock with a target price of 122 rupees, while Jefferies has a target price of 130 rupees. Back to you.
Thank you very much for that. Numbers coming in thick and fast. Max Healthcare reports an improvement in operating margins on a year-on-year basis. EBITDA margins coming in at 28% for Max Healthcare. PNB, on the other hand, has reported an improvement in its asset quality. The net NPA for PNB has inched lower, which is a good sign. And the profits and the NII has come in ahead of street expectations. But we're out of time on Midcap Radar, so we're going to hand it over to the next show, Your Stocks, to take the market action forward and answer all your stock-specific queries.